Okay, let's talk about wealth transfers and just your wealth and income potential throughout your lifetime. All right. Now, I'm 44 currently. Okay. If we look at just between my current age, 44, and retirement age for most people, which is age 65, we're not even talking through age 100, and we're just assuming that your income stops at 65. Even though if you haven't, think about this, if you have investments that are productive assets, which is what we're recommending people position their wealth into nowadays, productive assets, they can generate income, cash flow, well beyond age 65. But I'm just going to show you from age 44 to age 65 the effect of how much wealth is transferred. All right. Now, I've made a lot of money in my lifetime, but I'm just going to use $100,000, let's say $150,000 as ordinary income, which I think will give you a good idea. Let's say you're working at Dell Computer and you're making $150,000 a year. All right. Now, inflation in the United States is stated at 3%. You and I know that it's much, much higher than that on the things that we need to purchase, food and fuel, for example. But the Federal Reserve states our inflation rate at 3%. That is their target rate of inflation. It's actually 2%, which means they're going to steal 3% of your wealth and income every year for the rest of your life through inflation. All right? And let's say that Dell employee has $100,000 saved up in their 401k, IRA, mutual fund. Maybe they have it fully diversified. Some of it's in gold and silver. Maybe some of it is in oil and gas. Who knows? We're just going to use round numbers and examples here. Okay? Now, we don't know what the average rate of return is going to be on those 401ks, IRAs, and mutual funds, or those qualified and non-qualified savings plans and investment plans, because they fluctuate. And that's a key concept we're going to get into on the back end of this website, okay? But let's assume, which most traditional financial planners assume, that you can get an average rate of return. All right. Now, if this money was in a life insurance account, then it would be guaranteed to earn at least 3% every year. And right now, the current dividend that is being paid on these life insurance accounts is 6%. So we're going to assume that you can get the same kind of rate of return as you can get in these life insurance accounts right now currently today. Okay? Watch what happens when I hit calculate. All right? So between now and age 65, just in a very short time frame, a very short window of opportunity, making $150,000 a year, and that W-2 income growing at approximately 3% a year just to stay ahead of the stated rate of inflation, and having a little bit in savings that's averaging 6%. Look at these numbers here. This is insane to me. Just between age 44 and 65, my income potential is $4.3 million. That's how much income, just income, ordinary income, is going to be flowing through my personal economy. All right. So the first question you have to ask yourself is, how do you capture and control that? Because remember, there's only one of two things you can do with that money. You can either save it or you can spend it. If you don't save that money, you're going to spend it and transfer it out of your personal economy. Even if you write a check to pay tax on that money, you're transferring that $4 million out of your personal economy. Okay? Now, when you combine that with your savings, with your 401k or IRA or whatever savings account you have that $100,000 in, if it were to grow at the average of 6%, which is what the actual dividend payment is now on these life insurance contracts, your total between the two, between the income and the current savings, your total wealth potential is over $8.4 million, almost $8.5 million. All right? So my question is, at age 65, how do you end up with $8.5 million and not transfer that wealth? That's the whole key to what we teach people how to do. All right? It's a critical concept that we're walking people through here. Okay? Now, again, if you were able to capture and control all of that money and enjoy uninterrupted compound interest to the tune of about 6%, then at age 65 you would end up with almost $8.5 million in the kitty, in your savings account, in your nest egg, or your family trust, if you will, if you were able to capture and control it all. But that's not what we do. And this is where we transfer our wealth. This is critical here. The first thing we do is we pay taxes. All right. Now, on $150,000 a year, the average tax rate is 32%. Okay. Watch what happens when I calculate. That's sickening to me. Between now and retirement age, just in taxes alone, you're transferring $2.6 million to Uncle Sam. And it's not just the $2.6 million, okay? It's also the interest that you could be earning on that money had you not transferred those dollars. Remember, every dollar of wealth that you transfer is another dollar that you're not going to earn interest on, all right? But it doesn't stop there. The next place that we transfer our wealth is through debt service. Now, I have a really nice home, and yes, we have financed our home. We do believe that there's good debt and bad debt. Mortgage debt is tax deductible in America. So we prefer that type of debt over all other forms of debt. And so we finance our home, and we take that interest expense, and we reduce our tax liability through that interest expense. All right? Now, the National Association of Mortgage Brokers has said that in America, the maximum debt to income ratio, the maximum debt service that you can have on your personal economy, all of your earnings, is 35% in order to qualify for a home. If you have more than 35% of your wealth or your income flowing out of your personal economy in debt, then you can't qualify for that home. So that's how they determine what size of a house you can qualify for. They say, what is 35% of your gross income? All right? Watch what happens when you hit calculate. That's almost $5.5 million between now and age 65 being transferred out of your personal economy. That is a huge wealth transfer. And again, it's not just those dollars. It's the fact that you're no longer allowed to earn interest on those dollars. All right? That's a huge problem with the way that our current system is set up in our own personal economy. All right? Huge loss. But it doesn't stop there. We also spend money on our lifestyle, and that's just on housing costs, food, fuel, education costs, medicine, medical expenses, all of those things, everything that you spend your money on. Now, if you're trying to be conservative and not consume all of your wealth, again, the National Association of Mortgage Brokers has told us that the average lifestyle expense ratio in America is anywhere from 25 to 40%. So I'm going to hit that number right in the middle and just call it 30%. All right? Watch what happens when I hit calculate. At that point, you've transferred almost $8 million out of your personal economy, and it's gone forever, just between taxes, debt service, and lifestyle expenses. And again, it's not just that money that you're losing. It's the interest that you could be earning on that wealth over time. That's the problem with how we have our own personal economy set up. Another thing you'll notice is that when you transfer that wealth, it leaves very little cash remaining for you to start saving for retirement, for your future lifestyle. So if you're a working man and you're making really good income, $150,000 is good income here in America, all right? If you're making $150,000 and you're only able to save about 3% of that wealth, $3,000 a year roughly, $3,500 a year, $3,200, whatever that number comes to, that's horrible. That's a lose-lose scenario. That's a non-starter, if you will. You can't even begin to start saving for retirement, all right? And if you're starting to save for retirement at age 44 and plan on retiring at age 65, you're screwed. You're absolutely screwed at that point, okay? And so again, what we like to do is reverse this. We like to say, you know what? Don't pay Uncle Sam right now. Pay him on your schedule. Don't pay debt service to the home, the mortgage company or the car company or the credit cards or the student loans. Pay it in a different way. And then when you spend your money on your lifestyle, don't spend your money, spend someone else's money. If you're able to reverse that trend, then you can get way ahead of the game and you can start to really accumulate a ton of wealth in your personal economy, in your nest egg or in your family trust, and you can let it enjoy uninterrupted compound growth. All right? So that's the second key point that I wanted to illustrate. Now I'm going to jump back to the personal economic model and show you how that works.